If I asked you right now, why did you take your last trade? Could you answer in one clear sentence? Not the emotional reason, not the hindsight explanation, the actual rule that made you press the button, because that's where most traders quietly lose control. Not in the market, in their decision making. They wake up, open the charts, see something that looks interesting, add a couple of indicators, read a headline, and convince themselves it's a setup. Sometimes it works, often it doesn't, and the pattern repeats. The real issue isn't effort. Most retail traders are trying hard. The issue is structure, and more specifically, the failure to properly combine fundamental analysis and technical analysis in a way that gives each one a defined role. Forex trading isn't about picking sides randomly, it's about stacking probabilities. And to do that properly, you need what I call a two-key system. Fundamentals decide direction and timing window. Technicals decide location and risk. No trade happens unless both keys turn. Let's break this down properly. Start with your fundamental engine. Currencies don't move because of lines on a chart. They move because money flows between economies, and money flows based on expectations around growth, inflation, interest rates, and risk. So your first job is to understand the relative macro picture between the two currencies you're trading. Begin with central banks. Is this central bank tightening policy, pausing, or preparing to ease? What is inflation doing? Is it persistent or falling quickly? Is growth accelerating or slowing? What does the labor market look like? And most importantly, how are rate expectations shifting? Markets move on changes in expectations. If the Federal Reserve is signaling higher rates for longer and inflation remains sticky, that supports the dollar. If another central bank is leaning towards cuts because growth is deteriorating, that currency is under pressure. That gives you bias. Bias does not mean immediate entry. It means you know which side of the market you want to align with over the coming weeks. Then you define invalidation. What would make your macro view wrong? A sharp shift in central bank tone, a major inflation surprise, a sudden change in the global risk regime. If you don't define macro invalidation, you'll cling to a narrative long after the market has moved on. Now the second key, technical execution. Fundamentals tell you what side to be on. Technicals tell you where you are wrong. Start with structure, not indicators. Is the pair trending? Higher highs and higher lows, lower highs and lower lows, or is it ranging between clear boundaries? Market major weekly and daily levels, previous highs and lows, obvious areas where price reacted strongly in the past. That's where liquidity sits. That's where decisions are made. Choose one or two entry models. Keep them simple and repeatable. For example, break and retest of a key level within the direction of your macro bias, or a pullback to support in an uptrend, confirmed by a structural shift on a lower time frame. Define your entry trigger clearly. Define your stop placement based on structure, not a random number of pips. Define your target based on the next logical level or measured move, and include a time stop. If the trade does nothing after a defined number of candles, you exit. Capital efficiency matters. Now we talk about risk, the part most people underestimate. Before you even look for an entry, decide how much of your account you're willing to risk. 0.5%, 1%, whatever fits your tolerance, but it must be consistent. If your stop is wider, your position size decreases. If your stop is tighter, your size increases. Your percentage risk stays constant. Think in R. If you risk 1% and target 3R, you're aiming for 3% on a winning trade. This reframes trading from emotional wins and losses to mathematical outcomes. Set hard limits. Maximum daily loss, maximum weekly loss, maximum total open exposure, especially across correlated pairs. If you're long 3 US dollar pairs at the same time, you're effectively in one large position. Now let's apply this with a simple example. Suppose US inflation remains sticky and the Federal Reserve signals higher rates for longer, while European growth weakens and the European Central Bank becomes cautious. Your macro bias is US dollar strength versus euro. So you're looking to short euro US dollar. You wait for price to rally into a prior daily resistance level, a lower high forms. Price breaks minor support and retests it from below. That's alignment. You enter short on the retest. Your stop goes above the lower high because if price breaks that structure, your idea is invalidated technically. Your target is the next weekly support level. Risk is 0.5% of your account. If the macro story shifts, say US inflation collapses unexpectedly, you reassess the bias. If price invalidates the structure, you exit without hesitation. No guessing, no improvising. Execution based on a defined framework. That's the difference between reacting to charts and operating with a plan. A real trading plan removes emotion from the moment of decision. It tells you when to act and, more importantly, when not to. Fundamentals define direction, technicals define precision, risk management defines survival. Put all three together and you stop chasing trades, you start selecting them. If this helped you rethink how you approach your trading plan, make sure you like the video, share it with someone who needs more structure in their process, drop a comment with the pair you're focusing on right now, and subscribe for more clear professional trading education. Consistency isn't built on excitement, it's built on discipline.